Hello friends, welcome to Daily Dose of GK by Study Break. Today we are going to talk about the very basic functions of the Reserve Bank of India. This is part 1 and we will continue with the discussion tomorrow in the part 2. This is Shaktikant Das, the governor of RBI. You should know about him. Now, this is the map of British India. You can see the Bengal presidency here, the United Provinces, the Bombay presidency, the Madras presidency. This is Punjab and Sindh region, the northier frontier province, and the central provinces. Now, the British government had control over all these areas in India, and the yellow part that you see, they are Indian princely states. Okay, so they had their own banks from beforehand. Even in Madras, banks were conceived and started, and they did not work out in the 18th century also. But the first running bank, a bank that is still running, it was established in Calcutta in 1806, June 2, 1806. It was called the Bank of Calcutta, but 3 years later, it was renamed to Bank of Bengal because it actually covered or worked for many areas of the Bengal presidency. Okay, the main purpose of making this bank was to fund the British in the Mysore Wars and the Maratha Wars. So they would take money from, say, rich people who deposited in the bank, and they would fund their military expeditions. Now, after the Bengal presidency, say, achieved prominence, and then the banks started functioning properly. A major presidency that the British government saw in India was the Bombay presidency, and to maintain the commercial banking activities of the Bombay presidency, the Bank of Bombay was started in 1840 on April 15th. In Madras, the Madras presidency, banks were conceived from a long time. For example, you can see the Madras Bank was established in 1806, Carnatic Bank in 1788, the British Bank of Madras in 1795, and the Asiatic Bank in 1804. All these were headquartered in Madras, and all these amalgamated to form the Bank of Madras in 1843. Now, they ran over a period of time for around, say, 80 years to 120 years, and then all of them were merged into something called the Imperial Bank of India. The Imperial Bank of India came into existence in 1921. Now, you must understand all these banks had private shares, and you can see the Imperial Bank of India was 80% privately owned. You can see that here. Okay, now why did they form this Imperial Bank of India? Because they understood that all their financial institutions, the British understood that all their financial institutions and all their banks were privately owned. And in 1912, there was this famous book written by John Maynard Keynes called Indian Currency and Finance. John Maynard Keynes said that the government should have a regulatory body to control the financial activities or the economy of the country. Influenced by his book, the Imperial Bank was formed, amalgamating or merging Bank of Bengal, Bank of Bombay, and Bank of Madras. Okay, so the important thing was that it was still not government owned. It was 80% privately owned, and 20% stake was with the government. Now, one important fact here: Sir Badridas Goenka was an important business tycoon of his time and a prominent member of the Marwari community of Calcutta. He was the first Indian to be appointed as the chairman of the Imperial Bank of India. So this is the stamp of the Imperial Bank of India. Let us move forward. Now, in 1935, on the basis of the recommendations of the Hilton Young Commission, so you can see the document here. This is the recommendation document of the Hilton Young Commission. In fact, the Reserve Bank for India was conceived much before in 1926. It was rejected, conceived again in 1929, rejected. Then the Reserve Bank of India Act came in 1934, and it provided the statutory basis for the functioning of the Reserve Bank of India. You must remember that the Reserve Bank of India was still a privately owned bank, but Imperial Bank of India, if you see, Imperial Bank of India managed both the functions of the central government and the functions of a retail bank or an investment bank also. Now, it was too much for Imperial Bank of India because the economic activities in India increased greatly in the 1920s and 30s. So the government brought in the Reserve Bank of India, Reserve Bank of India, remember the act, it was in 1934. So Reserve Bank of India took over from the government the functions so far being performed by the controller of currency and from the Imperial Bank of India, the management of government accounts and public debt and all. But later, after independence, it was nationalized. The RBI became a government entity in 1949, but till 1949, RBI was privately owned. In 1955, Imperial Bank of India was renamed to State Bank of India, okay, pursuant to the provisions of the State Bank of India Act. The Reserve Bank of India acquired a controlling interest in the Imperial Bank of India and later in State Bank of India. In 2008, the government of India acquired the Reserve Bank of India's stake in State Bank of India so that there is no conflict of interest. Like, okay, I have a conflict of interest in State Bank of India, so probably I'll give more provisions or easier lending rates to State Bank of India because I have a stake there. So to avoid that, because many banks, private banks and other banks were also started before 2008, the government of India actually acquired the Reserve Bank of India stake in SBI. Now, as you can understand, Reserve Bank of India is the one who decides the policy. So this was the first board of directors of the Reserve Bank of India. Okay, you can see the newspaper cutting. The Bombay office begins business, Reserve Bank of India. So this is the first 10 rupee note that was published in 1938. You can see the seal of the Reserve Bank of India here. Now let's come to the modern day Reserve Bank of India. So, in 1991, liberalization happened. The RBI's focus shifted from, say, managing day-to-day activities of the banks and probably, say, lending to, say, critical areas, lending to priority areas, and probably removing investment in not so economically growing areas and all. These were the focus of RBI before 1991. But after 1991, RBI took the major role as a central bank. Now, central banks across the world have all these functions. The one that you can see, the main functions here. Of course, they have hundreds of functions, but these are the main functions. Okay, regulation and supervision of the financial system, banking and debt management of the government of India. So you must have seen recently, because the government of India faced serious losses because of the COVID-19 pandemic, the RBI actually gave its surplus revenue to the government. Regulation and supervision of the banking system across the country. Banking for the bankers, like in case SBI or say ICICI Bank wants to create an account, it creates an account in RBI. And they say probably say send money and receive money from across the borders. So if somebody from England needs to send money to an ICICI Bank account, so he will send it through Reserve Bank of India. Reserve Bank of India also issues currency notes, as you know. Regulation and supervision of the payment and settlement systems. Now, all the payment systems, all these systems, like you must have heard of PhonePe and Paytm, all these have to be approved by the Reserve Bank of India. The Reserve Bank of India also manages foreign exchange. You may have heard of the Forex Reserves of India, which is managed by the Reserve Bank of India. Research and development of the financial system, that is regularly done by the RBI. Financial inclusion, what does that mean? Now, it focuses on agriculture, it focuses on MSMEs, it focuses on rural business, so that there is financial inclusion. It shouldn't be that only the rich businessmen get richer and richer and the poor are rendered poor. So they must also get equal opportunities, and RBI tries its best to manage financial inclusion. It's also a detector and observer of fake currency. Now, these are the important functions of RBI, not all of them by any means. Let's move forward. Now, what is the monetary policy? Now, monetary policy is really, really important because we are focusing on one or two important functions, not all 10 of them in this module. One or two, mainly the macroeconomic policy that the RBI makes. The macroeconomic policy laid down by the RBI is known as the monetary policy, okay? And you may also call it the demand side economic policy used by the government of the country. Okay, now it involves management of money supply and interest rates. Now, money supply is how RBI prints money. Okay, now interest rate is what we are going to talk about in this module. Now, in 2016, the Reserve Bank of India Act 1934 was amended by the Finance Act. This provided a statutory framework for a monetary policy committee for maintaining price stability while keeping in mind the objective of growth. Like previously, before 2016, the monetary policy department of the RBI managed the quarterly or the bi-monthly monetary policy. But after that, in 2016, according to the Finance Act, the monetary policy committee was framed. Okay. Now, as per the provisions of the RBI Act, there will be a total of 6 members in the Monetary Policy Committee, 3 of which will be from the RBI, and the remaining 3 would be appointed by the central government. Otherwise, what happened is, in case RBI manages everything, the central government would actually put a puppet RBI governor, or maybe somebody, or probably affect the decisions of the RBI. RBI will not understand the requirements of the government, so members of both the stakeholders are involved. Now, the Monetary Policy Committee is entrusted with some duties. Number one, fixing the benchmark policy rate, which is also called the repo rate. We will talk about it in tomorrow's session. But the main job that it does is to maintain inflation within the specified target level, which is, in fact, in yesterday's news, they said that till 2026 March 31st, the benchmark inflation, or the specified target inflation, will be 4% with +2 or -2 tolerance level. Like, it may be anything between 2 and 6, but ideally it should be at 4. Okay. Now, the meetings of the Monetary Policy Committee are held at least 4 times a year, but generally 6 times a year. Okay. And every time it has a meeting, it publishes the interest rates and the policies, the monetary policy of the Reserve Bank of India. Okay. Now, you may have heard that the RBI has been reducing the repo rate regularly because of the COVID-19 pandemic and the economy hit that it caused. Okay. And all those things are done every 2 months. Now, every time there is a monetary policy document published after the meeting, the RBI members, that is the Monetary Policy Committee members, they have to maintain a silent period for 7 days before and 7 days after the rate decision, so that there is confidentiality. Like, nobody should actually know what the monetary policy will be and act accordingly, so that they can earn a hell lot of money from the stocks or from some other kind of business by predicting the share values and all. Okay, that's why they maintain this silent period. Now, the monetary policy of Reserve Bank of India, the primary purpose of it is to manage the quantity of money in the economy, okay, in order to meet requirements of different sectors. So, you can say there are 3 main jobs of the monetary policy. One, to manage the quantity of money through various methods. To push funds into development areas, okay, to improve the pace of economy, and to shift money away from the unnecessary areas, or those areas which do not bring development but only lead to inflation. So, how does the monetary policy manage this? How does the Reserve Bank of India or the Monetary Policy Committee manage this? So, they do open market operations, moral suasion, bank rate policy, reserve system, liquidity adjustment facility, credit control policy, and many other things. But these are the 6 most important things that we must know about the Reserve Bank of India. Now, today we are going to discuss a few of them. So, what are open market operations? Open market operations are buying and selling of government securities, like government bonds, or government other types of government securities, to the public or to the banks. Now, why is this important? Because the RBI might sell government securities to control the flow of credit. That is, if I sell government securities, I am going to say, I am RBI, so I am going to sell some government securities and I am going to get the money and keep the money with me, which means that the public or the banks do not have enough money to lend or to invest. So, the inflation comes down because people are not ready to buy things. On the other hand, if I start selling government securities, then I am actually if I start buying government securities, then I'm actually providing money in the hands of the public or in the hands of the banks to invest or to lend further, so that there is more economic activity and more economic growth. Okay, that depends on the situation. How does the RBI handle it? Now, what is moral suasion? Moral suasion means the RBI actually requests the commercial banks that, okay, you do not lend to this particular this particular, economic area or unproductive purposes. You rather lend to agriculture or maybe those areas which actually bring economic growth, not to those areas which just bring inflation and not economic growth. So these are all controlled by the RBI through moral suasion, and banks have to listen to them, because banks will have to be in the good books of RBI to function properly in India. Now, what is the meaning of bank rate policy? Till 2010, July 1 to be specific, till 2010, India had something called the benchmark prime lending rate system. Okay, where benchmark prime lending rate is the rate at which commercial banks charge their customers. Now, what is this benchmark rate? Benchmark rate is the charge that they levied on the most credit-worthy customers, like the best customers who are sure to return your money. So I'll give you at a, say, lower rate, because somebody who is not that credit-worthy will get it at a higher rate. So the lowest rate was BPLR, or benchmark prime lending rate. Now banks could fix the BPLR with the approval of the board of directors. Okay. Nevertheless, what happened was RBI implemented the repo rate and the cash reserve ratio and all those things, which we will see eventually, and affected the BPLR. Eventually, the decision was affected by the government, and it was not only exclusively the bank's decision. Okay, as a result, the government of India in 2010 they did away with the BPLR system because it failed to bring transparency, because many a time it happened that the banks did not disclose the BPLR and they lent at a much lower rate than the BPLR, whereas some other bank was probably following this benchmark, and that's the reason why they could not get business. So there were a lot of controversies, and the government said that, okay, there must be transparency in lending. So they started something called the bank rate policy. Like, they did away with the benchmark prime lending rate policy, but they started the bank rate policy. Of course, nowadays also at some places you will see the BPLR, because like there were some loans which were given on the BPLR and they are still continuing, but otherwise mostly it will be gone in a few years. Now, what is bank rate? Bank rate is the base rate at which each bank will share or will lend its money. Okay, now the bank rate is different for different banks. So you can, if you are a bank, you can create your own bank rate, but again that has to be maintained, like whether it will affect the business. So there must be an optimal thing where it doesn't affect your business but it attracts customers too. So banks actually fight it out and they automatically get to the best bank rate. Another thing that the government has done is the banks have to declare their respective bank rates in the website in order to make lending more transparent. Okay, so that is an important thing that brings in transparency. It's a clear cap on lending, like I cannot lend above this amount. Okay, so that is the bank rate policy. That is how the government has actually affected the money flow in the economy. Next thing we are going to talk about is the reserve system. Now, before we go into the reserve system, you should know the meaning of a few terms, two in fact. So first one is NDTL, the full form of which is the net demand and time liabilities. Now, there are two types of liabilities that the banks have. One, the demand liabilities, and two, the time liabilities. Now, demand liabilities are those which must be given to the customer on demand. So suppose I have a savings account, I have some money in it. Whenever I want, I can withdraw that money. Okay, or say I have some fixed deposit which has matured. Now I can take the money anytime I want. I may keep it in the bank, but I may take it anytime I want. Okay, so those are demand liabilities. Now, what is time liability? Time liabilities are those which will be repaid only on maturity. Like, you cannot pick it up or withdraw it right away. There is a maturity date and you will only be able to pick it up on the maturity date. So these are your demand liabilities and time liabilities, together called NDTL, or net demand and time liabilities. Okay, a few examples of demand liabilities would be current deposits, demand drafts, like overdue fixed deposits, demand liabilities from saving bank deposits and all. A few examples of time deposits would be fixed deposits which have not yet matured, liabilities portions of the savings bank deposit. Now, one part of your saving bank's account money might be kept for time liabilities also, staff security deposits, and all those things. Okay, so this is one. The second thing is liquid assets. So what are liquid assets? Liquid assets are those which can be converted into cash without delay. So liquid assets are those things which can generate cash immediately or within a day. So gold, treasury bills, government approved securities, government bonds, cash reserves, these are all liquid assets. Okay, it also consists of securities, okay, and certain market borrowing programs and all. Okay, so these are your net demand and time liabilities and liquid assets. Now, under the reserve system, the foremost technique that the RBI actually uses to control the money flow in the system is the cash reserve ratio. Now, what is cash reserve ratio? RBI says that banks should store a proportion of their deposits in the form of cash and some proportion of its deposits in the form of liquid assets. Okay, so the percentage of cash required to be kept in reserves by the banks with RBI is called the cash reserve ratio. That is, once again, the percentage of the cash that every bank needs to keep in the RBI as reserve is cash reserve ratio. The current cash reserve ratio is 3%, as you already know. CRR in India is decided by RBI's monetary policy every 2 months, okay, 6 times a year in the periodic monetary and credit policy. Banks do not get any interest on the cash reserve ratio, they just have to keep it. Now, what is the meaning of cash reserve ratio? Suppose you say the cash reserve ratio is 3%, then whatever is the total net demand and time liabilities of the bank, 3% of that must be kept as cash with the RBI. Okay, the bank cannot use this money for investing or lending. So this is your cash reserve ratio. What are the objectives of the cash reserve ratio? See, whenever there is high inflation in the economy, the RBI increases the cash reserve ratio. Why does it do so? In case the RBI increases the cash reserve ratio, then the banks will have to keep more cash with the RBI, which means they'll have less cash to invest or less cash to lend, which means less cash in the hands of the people, and the inflation will come down. In case the inflation is low, the government needs to pump money into the system. It lowers the CRR rate. Like you must have seen during the COVID-19 pandemic, when the economy was hit very badly, the government kept on lowering the CRR rate. Okay, now it's 3%, which means that the banks do not need to keep much money with the RBI, which means it can lend money or invest money, which means the economy will grow. Inflation may also grow, but economy will grow, because at this time we need our economy to grow. It helps the banks to provide loans also to large number of businesses and industries, and they in turn invest and generate more GDP, more employment. Lowers, if the CRR is very low, it boosts the growth of economy. If the CRR is very high, it controls the inflation. Okay, so that is basically the idea of cash reserve ratio. Now, the minimum percentage of deposits that the commercial bank maintains through liquid assets, okay, is known as statutory liquidity ratio. Statutory means mandatory. Liquidity ratio means how much liquid assets should you keep. Now, that is SLR. Now, CRR and SLR are complementary. Section 24 and Section 56 of the Banking Regulation Act 1949 mandates all scheduled commercial banks, local area banks, urban cooperative banks, state cooperative banks, central cooperative banks, all cooperative banks, all commercial banks should maintain an SLR of whatever the RBI mandates. Now, these deposits are maintained by the banks. Like CRR can be kept with the bank, can be kept with RBI also, but SLR has to be kept with the bank, and the RBI doesn't keep these gold or other securities and all. The highest SLR is around 40%, and the lowest SLR was actually thought to be 23%, but it was lowered because of the dire situation of the economy. Now you know the SLR is about 18%. Okay. Now, what is the objective of, or rather, what are the objectives of the SLR? First thing, SLR helps to curtail the commercial banks from over liquidating. That is, the commercial banks will have a habit to create more and more liquid funds. As a result, what happens? It keeps on, say, buying gold and other securities so that whenever they want, they can convert that into cash. But for greater benefits, for higher returns, banks will have to invest in non-liquid funds also, probably time deposits, which will mature after a long period of time. Okay, so over liquidating is something that the banks do, and the SLR is a means for the RBI to control this over liquidating thing. A bank or a financial institution can experience over liquidation in the absence of SLR, when cash reserve ratio goes up and the banks are in dire needs of money. Now, the second thing is RBI employs SLR regulation to have control over the bank credit, like how much credit will be given, how much can it keep as, say, liquid assets, how much can it keep as cash, and how much should it invest in long-term assets. SLR ensures that there is solvency in commercial banks and assures that banks invest in government securities too, because government securities are generally long-term securities. So that the banks invest in government securities, the RBI uses SLR to control that. Okay, and it also maintains solvency. That means in case there is, say, dire need of funds, or there is a lot of requirement of money in the system, then they can actually liquidate these assets and then use that cash for probably returning money to the depositors. The SLR also helps to increase or decrease the flow of bank credit. The Reserve Bank of India raises SLR to control the bank credit, because now you have to keep SLR in your bank. If the SLR says 35%, so 35% of your NDTL should be kept as SLR, so that you don't have enough money to invest, so that the inflation comes down. Similarly, it reduces SLR during the time of recession to increase bank credit. For example, now the SLR is as low as 18%. So this is done so that the banks can invest more and more. It doesn't need to keep much money as assets. Okay. Now, the RBI's one of the most important jobs is to balance the CRR and the SLR, as you can see in the picture. So tomorrow we will continue with the second part of this discussion. Thank you.